Hello, folks. Welcome back to Market Junkies in part two of our Lemonade stock analysis. I do apologize for not being able to fit it all in, but I hope all those from part one have joined for part two. This session, we're covering off the financials, the outlook in Catalyst, and then finally going to give our final thoughts of the stock. So let's have a look at the financials, okay? Their IFP has increased by 84% to 346.7 million as compared to the third quarter of 2020, primarily this is due to the increase in customers as well as the increase in premium that they've seen. And it's good that they notice the difference between these two metrics. Customer count is now 1,363,754. That's an increase of 45% when compared to the third quarter of 2020. So huge improvements there. And then we have the premium per customer. Now, this is defined as in force premium divided by customers. Okay. It sits at $254 at the end of the most recent quarter. That's up 26% from the third quarter of 2020. Primarily, this is due to the continued shift, of our business mix towards products with higher average policy values. But what's really interesting is that this is clearly a consistent strategy within the business because if you look at their metrics over the last 5 years, this is one alongside customer wins, I should say, the premium per customer has been on such a constant increase. It's quite unbelievable actually. I've never seen anything like that, and it may well be because I'm not that well versed in the insurance industry, but I love the way that they're increasing the spend or increasing the value of their existing customers. So third quarter revenue sit at 35.7 million, and that's increased by 17.9 million or 101% when compared to the third quarter of 2020. Really good growth there. We've also got the gross profit increasing by 60%, now sits at 11.7 million. And so that's increased by 4.4 million when compared to the third quarter of 2020. Primarily, that's due to the increase in gross earned premium, which is partially offset by a higher net loss ratio. And then we've got the operating expenses, okay, which is included in this figure here of 82.4 million. That's increased drastically. So we're looking at 98% increase for the same year, the same quarter the previous year. That's so the previous year, it sat at 41.6 million. Now, the reason this is, and the reasoning given, is that it's driven by increased investment in advertising, which you expect within hypergrowth, and employee related expenses to support that growth and expansion. Alongside that, we have technology development and general and administrative tasks, which has been driven by increased employee related expenses and overhead costs, of course, due to support their growth. Those figures, although high, I'm not too concerned with because as long as the customer numbers and retention and premium is improving upon, as well as their cross selling figures, I don't think the mountain losses are anything to be too worried about just yet. And then we have the net loss, of course. In Q3, 66.4 million or $1.08 per share. That's comparative to 30.9 million or 57 cents per share for the third quarter of 2020. So massive increases in the net loss there. Again, I echo my same sentiments around the expenses simply because the losses are mounting. It's nothing to be massively concerned about at this point because of the growth that they put in play. And now we have the company's cash balance. So they currently sit with about 1.1 billion. Okay, you've got to remember the elements of this will go into their second quarter acquisition of Metro Mile. So you may well do well to split this in half. I don't believe any money's changed hands currently. I could be being a complete fool on that. And if I am, just jump in the comments and berate me because these videos are as much for my due diligence as they are for everybody else, right? So I hope that's accurate. And I apologize if it isn't. And now I want to give my final thoughts. This is a real disruptive tech player. They're constantly achieving growth aims through customer acquisitions and increasing customer spend with multiple policies. It presents a pretty compelling case. The recent entrance into the pet market in the States and the acquisition of Metro Mile, I believe, is going to put them in seriously good stead to lead in those product niches. Metro Mile has that already delivered technology, but we're also absolving the employees that have the expertise, which is just fantastic. I really am. I think that deal's a complete steal. I really do, and I think that pet market growth potential is huge also. It was 37.5 million in revs last quarter. Clearly, we're on a good trajectory, and you can see that from the last 5 years. The progress is exciting. I think the key thing for me is the management team is full of innovators. They've successfully disrupted other industries by leveraging technology. So it appears that it's destined for long-term success on the face of it. But equally, of course, costs are rising. Now, those risings, they've given their reasonings for it. And of course, if there's anything that sort of fragments that growth there, and those costs continue to gain speed and sort of come out of control, then that would be quite concerning. But I think with the management they have in play and what they've already delivered on in their previous experiences, I just can't see that happening. Now, currently, the company sits not too far from all time lows, okay? They're pretty near their IPO price, valued at around 2.2, 2.3 billion. Now, given their success to date, their shrewd acquisitions and their data driven approach, in which they enter the most profitable product offerings in insurance, as well as the fact that they're catering for digital consumers. That's the focus, it's digital consumers in what is a legacy industry. I believe that at this level today, the company is a complete steal, complete and utter steal. I think as long as you're willing to hold through any economic uncertainty of the next 12 months, which to be frank, we're going to see it. I think that the debt market's an interesting position today, but that's not relevant to this video too much. But it is in terms of how the market's going to act. I think you could be on for at least two, three, four, five xing here. I really do. Um, I think they're a really exciting pick, and I think the management. I've never come across a management team that I'm that impressed with from the first pass, and so yeah, I think from us at Market Junkies, it's definitely a buy and most certainly a hold at current levels. I think we need it to give the market time to, I guess, settle more than anything, and then from there, I think this company only goes one way. But look, thank you ever so much for sticking with us. I hope many from part one came over to part two, and contact me on the socials below. I do apologise for the length of this one, but I hope it added some value. And look, if you've got any insights that I've missed or anything that's incorrect in the video, hey, look, let me know. I'm an amateur myself, right? I'm on this journey. I'm trying to build out this YouTube channel, and also, I guess, my approach to the market and my market understanding. So it's as much for me as it is for you guys. But thanks again, and enjoy your days.